Get ready to embark on an economic journey as we unveil the heartbeats of the Rwandan business landscape. This is the Business Age, your front row seat to the economic renaissance of the land of 1,000 hills. Join us as we traverse the bustling markets of Kigali, delve into the success stories of Rwandan entrepreneurs, and explore the dynamic forces shaping the nation's economy. From the boardrooms to the street vendors, we'll bring you the voices of the visionaries and the minds behind Rwanda's economic evolution. Discover the fusion of tradition and technology, witness the agricultural innovations transforming rural communities, and explore the cutting-edge innovations propelling Rwanda into a new era of economic prosperity. From the city lights to the rural landscapes, every business is a story waiting to be told. Hello there. Thank you so much for tuning in to today's episode of The Business Age, where we bring you the latest updates on the market and business trends. You'll be with me, Naringwa Fiona Mothoni. On today's edition, we will dive deeper into the recent decision by the Central Bank of Rwanda on the Monetary Policy Committee meeting that was held. At the heart of a central bank's operation is the Monetary Policy Committee, who meet regularly to assess the economy and determine key policy rates such as the interest rates. These rates influence everything from the cost of borrowing to inflation and currency stability. We start by unpacking the recent MPC decision.
We expect to see average inflation for 2024 at 4.6%. Even below our benchmark of 5%. So, and this comes, achieving this, there are many contributors to this reduced inflation from the double-digit numbers we had in the last 2 years. So, of course, one where the main drivers of this, or causes of this inflation was food prices because of poor performance of agriculture here, and then international prices. So food, we had very good agriculture performance this year, so that contributed to reduced food prices. International commodity prices, we had measures taken globally that started seeing inflation going down from way above 8% to below 6% now. So that has helped. The two main drivers of the economy has really helped. I mean, the inflation has helped to reduce the inflation. But we as monetary authority, we also took action to deal with any second round effects coming from these supply shocks. And this helped to stabilize inflation. So we saw it coming down as we had projected, coming down end of last year, and has remained stable for this year. So we expect the same next year. We expect it to be still within our band, though slightly higher than our original projection of around 5%. Because again of climate change, we expect season A of next year, that's first few months of next year, agricultural performance won't be good, especially in our eastern province with our main producers of maize and beans. So we expect some pressures on the food prices. That's why we had adjusted our projection for 2025 from 5% to 5.8%, but still within our band. Briefly, I would say, looking at the monetary authority, from the monetary authority point of view, it's a much better year. Though in terms of the economy in general, it's been strong for 3 consecutive years. In fact, 4 consecutive years. 10.2, 21, 8.2 for the last 2 years. This year we're projecting it at 8.3, so it remained strong. Normally when we take policy decisions, we say we are taking this policy stance at this rate because these are the projected behavior of inflation. But there are these risks, mainly climate change and geopolitical risks. So this 5.8 we are giving for next year, we're already incorporating the risk, the climate change that we see materializing already for season A, and so that's why we're increasing it 5.8. So again, we are saying there are still political pressures, geopolitical pressures, war in Ukraine, war in the Middle East. We don't expect, we hope these won't escalate. If they, then we are ready to take other measures.
What were the key drivers, whether it's within a local, the local economy or even the global context?
What we've seen so far on the global side, there's no big change. We still see slowdown in economic growth globally. This is a continuation of the efforts, previous efforts by the central banks globally to reduce inflation. Therefore, they've increased their rates. Inflation globally is then reducing. That's a good thing, and commodity prices are also reducing and continuing to reduce in the medium term. Now, the implication for us, our inflation is still projected to be within the band of 2 to 8%. We adjusted our projections. We have slightly lower projections for 2024. Overall is 4.6%, and slightly higher projections for 2025 with an overall average of 5.8%. So the reason why we have revised up our projections for 2025 slightly is because of food inflation that we see beginning of next year or even end of this year. We see some pressures on some food items because there have been delays in rainfall at the beginning of this season, during the planting season. So usually this affects the volume of production of food products that we can get in this season A. Therefore, we see some slight pressures on prices. But overall, if you put all the numbers together, still 5.8% is within our band. So that's the reason why the MPC decided for the moment to pause the past two rounds, MPC reduced the rates. So for this time around, MPC decided to maintain the rate at 6.5%, looking at what will happen in the coming months. One risk for, even if we are factoring in a lot of things, including this possible pressures on food prices, one risk that we are seeing is still this, what's happening globally, the geopolitical fragmentation, the tensions around the wars globally. We see in the news what is happening in Russia, Ukraine, in the Middle East, etc. So for the moment, on global prices, there's no impact, but there's a risk that maybe things get worse, there could be an impact on international commodity prices. So that's the main risk we are seeing, but for the moment, our inflation remains within the band, and that's why the rate has been maintained.
One of the MPC's most powerful tools is the interest rate. By adjusting the interest rate, the central bank can stimulate the economy. Dr. Thierry takes us through the current economic outlook.
The economy is performing well. This year, 2024, we've had very good growth of all sectors actually. The first 2 quarters we saw the numbers released by NISR, 9.8% economic growth, GDP growth for the first 6 months. We have other indicators we follow for quarter 3 and even some indication of quarter 4, which makes us think that actually it will remain high. The overall projection for the year has been revised up. The Ministry of Finance has published that or mentioned that. You also heard the IMF talking about a number of 8.3% for the year. So right now that's the new projections, but we may even exceed that. So on the side of economic growth, we saw sectors in services driving growth, like trade services, financial services, ICT, hotels and restaurants, especially the first 6 months, and tourism-related services. Even if in Q4 we expect a slight impact of the Marburg virus, because some conferences have been delayed or postponed, to another date. But overall, the impact is not that big on the overall sector. Industry sector, construction is performing very well, also manufacturing sector. For agriculture, as I said, we had a very, very good agriculture season for the first 6 months of this year. Then a moderate one for the season B, so the second season of the year. So that's for 2024. As I said, for 2025, we may have challenges with the new season A. But overall, industry sector and services sector are performing well. Therefore, we have in the medium term, 25, 26, projections close to 7.
Looking at even the specific sectors that you've mentioned in the larger economy, and also some of the risks that you've mentioned, the geopolitics, the fragmentation that we're currently seeing, everything is being imported into developing worlds. Is there anything that could be done to protect the local economy?
No, that's a very good question. I think we're not the only ones. All developing economies are facing that. One way or another, when there's a shock globally, indirectly we may be affected. And the channels are different. Either it is through trade disruptions, so therefore commodity price is going up, transport price is going up, logistics, etc. But for us, like many other developing economies, I think the key to be less, I think what you're asking is how can we mitigate the possible impact of these global shocks to our local economies. I think the main thing to do, and I think that's what the government is doing now, is trying to boost the local production and trying to diversify our exports. We've achieved for the past 10 years a very good, I think if we look at the different metrics of diversification of exports, we are doing way better than 10 years ago, where we were mostly relying on coffee, tea, and free tea minerals. Now we're exporting some more different products like manufactured products. So that's the way to go. I think we need to continue diversify our exports so we can actually limit the possible impact of global shocks on our economy.
Diversifying exports, then we look at the current trade deficits that the country has. Maybe if you can give us the current numbers. We saw it has widened. To what extent? Where are we currently?
What we saw in Q3, we can notice two things. One, there's good news on the side of exports because we saw a sort of resumption in exports activity. The first 6 months we had very low exports this year, but the third quarter we saw an increase, very significant increase in coffee exports. And also some manufactured products for which they are exported to the region. We saw that there's been an increase in demand there. That's the good news. So overall, Q3 it was 13.5% growth in exports. For the entire 9 months, it's 4% growth in exports. Now, the issue is that despite this growth in export, we still have continuous demand for imports. Imports have increased for Q3, the growth was 8.5%. So all in all, if you put that together, because we still have a coverage of 50%, let's say exports to imports, therefore, the base of imports is big. So when imports are growing, we still see a deterioration of the trade deficit. This deterioration of the trade deficit is happening, but it's partly compensated by other inflows of forex we are getting. I was talking about tourism. Tourism revenue is increasing fast. We are also seeing an increase in remittances from the Rwandan diaspora, sending money to people here. and foreign direct investment. In a way, it's partly compensating that. So all that together is the reason why we are seeing a bit less pressure on the franc rwandais this year compared to last year, even though it's still higher than usual with this close to 9% depreciation this year. It's half of the level we had last year, which was 18%, but still a bit higher than the usual normal, or let's say historical average of 5% depreciation.
Would you give us an overview of the local currency performance, and also just even touch on the exchange rate pressures that we're seeing with the depreciating currency and the US dollar also continuing to gain dominance?
Yes, so basically the main reason of the depreciation is this trade deficit, and the pressure is coming from imports, I would say, that I was explaining. But if you look at the dollar, it's true that the dollar from 2022 and maybe part of 2023, it was appreciating also due to the the central bank of the US, the Fed decision to increase the rate. Right now it's the opposite. The Fed started to reduce the rate, so it's putting less pressure globally. But of course the dynamics of the dollars vis-a-vis the rest of the world depends, from one country to another. I would say that in our specific case now, the pressures are less coming from the policies of the Fed, but they are more coming from this trade deficit and the pressure we are seeing on the trade deficit. But as I was saying, historically, the past 20 years or so, on average, we've always had 5% depreciation. This level of 5% could be, let's say, an appropriate one if for a country that is developing fast, that needs imports, because for the moment is not able to produce the products, the sophisticated products that we need in our infrastructure development and construction activities, etc., manufacturing, the raw materials that are specifically needed for our market. So in this period, we need imports, therefore the pressure on the exchange rate. Exchange rate depreciating to a certain level allows also for boosting competitivity of our export, allows also to reduce some extent the demand for our non-essential imports. So if we go back to around 5%, we'll be on track. What's not good is really the depreciation we saw last year. 18% is too much, and shouldn't be. This level of depreciation should not last for long. If it does, it will hurt the economy. So what we are seeing here is that it's gradually coming down. I hope that if pressures adjust, can go back to this historical level of 5%.
What is the current outlook on financial stability?
On financial stability, we are also seeing, from a financial stability point of view, that all the indicators are within the range, the normal range that we are monitoring, both if it's capital, it's liquidity, the ability of people to repay their loans. The non-performing loan is actually going down. It's now 4.2%. It's lower than the maximum we are defining as at 5%. So the financial sector for right now is sound and stable, and the outlook is that unless there's something really unusual happening, we are monitoring the risks, of course, but the financial stability, let's say the financial sector will remain stable. When
you're looking at the banking sector's health, how do you assess the current capital adequacy when you're looking at liquidity as well? Just give us an assessment of the health overall.
Yeah, all these indicators, so the capital adequacy ratio, the liquidity ratio, NPL, for the banking sector, for the MFIs, even for the sector at large, but especially for the banking sector, they are well above the requirements in terms of the capital requirements, liquidity requirements. So there's no particular issue there. Banks remain profitable. Their profitability has increased in the past few months. So they are managing well their loans, their ability to to follow up. Their ability to their costs have been reduced. So for the moment, all the indicators we are seeing, we don't see any particular issue, may it be capital or liquidity or even the NPL.
And what are some of the risks when you're looking at the health of the banking and financial stability at large?
And for there's maybe some other risks that are specific to the financial sector, which now could have impact on the economy. You know what's happening, the cybersecurity issues globally. There are attempts, there are, of course, people trying to take advantage of new technologies, trying to attack systems. But for now, I think our system is very robust, and the banks are aware, and they are doing everything to also mitigate this risk. Apart from that, these issues, geopolitical issues, affecting both the commodity prices that can affect domestically operators in the sectors, let's say manufacturing sector, the trade sector, and maybe at the end affect their ability to repay a loan. That's the transmission to which a risk like the escalation of geopolitical tensions could affect the financial sector. But for the moment, what we are seeing is that the international prices are going down. We have international prices going down on one hand. We have depreciation of the currency on another hand. So they kind of, let's say, compensate or each other. Therefore, there's no much impact or, let's say, risk today on the ability of businesses to repay their loans, therefore on the financial stability. So for the moment, we don't see any issue, but we are monitoring all these risks.
What are the numbers when you're looking at a trend in mobile money or even mobile banking, and also vis-a-vis to bridging the gap when you're looking at access to financial services and bringing inclusivity across all areas of the country?
The recent FinScope survey report that was published, and the numbers are very good in terms of financial inclusion. So we are, I think, now a total 96% financial inclusion. And if you look at the components and the drivers of this financial inclusion, it's really, really a big impact of mobile money and the use of digital services, digital financial services. So so to answer your question, it's really the main reason driving financial inclusion so far. Access, to finance, to financial products. Now, the next step and what we are focusing on is going from the access to financial to more usage, like access to loans, access to formal loans, and products from the banking sector. Access to these insurance products from access to these bank loans, and that's where I think the next step is in terms of boosting financial inclusion, because there are still things to be done. Overall, financial inclusion is good. Mobile money numbers and the use of mobile money services, you saw that in the presentation, they're increasing continuously, but we need to put more effort on the usage of formal financial products.
We'll look at some of the emerging trends that we witnessed in 2024 that impacted economies across the region and what to expect as we enter 2025.
2024 is a good year for us and for the region. When you look at us, Uganda, Kenya, Tanzania, inflation has been really contained. So we've had good agricultural performance across the regions. The external pressures were equally eased across the globe. So as we are enjoying the reduced global prices, same. So apart from the Southern Africa that had real drought that affected their inflation, affected their performance, but just drawing on our region, I think we've been moving in the same direction. We've seen policy rates reduce in Uganda, in Kenya, and so nothing unusual has happened this year. And despite the wars that are outside there, that we used to talk about the Red Sea issues, but they didn't really materialize as big as we had feared. So we hope going into 2025 that the true risks, climate change and geopolitical challenges, people are talking of the change in government in the US, so we hope to want to destabilize globalization. So these are uncertainties that's the world we live in today, and the good thing is we all growing our analytical capacities and are able to project what's going to happen and see what tools to use to counter whatever is happening. So we're talking of droughts. I was reading, so there's fear of floods in the Horn of Africa, so we expect to have more rainfall coming, so we don't know how big that will be affecting agriculture. But generally speaking, we've had a good year across the region, and as you see, East African bloc, in fact, even in terms of the economic growth, is going to be much higher than all the other parts of Africa.
Well, there you've had it. You've heard from the governor of the Central Bank of Rwanda as well as the chief economist of the Central Bank of Rwanda on the recent Monetary Policy Committee meeting and the decision to maintain the central bank repo rate at 6.5%. You are with me, Naringwa Fiona Mothoni. Thank you so much for tuning in. Until next time, stay well.